welcome to Week to Prime. We're discussing the GDP data that's just come in for the fourth quarter and also for the full year. For the fourth quarter, growth came in at 4.7%, and for the full year, we got growth at 8.7%. Nominal GDP growth quite strong. Sorry, for the fourth quarter, it's 4.1%. I stand corrected, and for the full year, it is 8.7%. Nominal GDP growth at 19.5%. Extremely strong. Lots to delve into within these numbers, and joining us to do just that, Shubhada Rao, founder at QuantEco Research, Joshi, chief economist at CRISIL. Thank you both so much for joining us. Seeing Shubhada here after a very long time. So, Mr. Joshi, allow me to put the first question to her. Shubhada, headline numbers, I know there's lots to get into, but what's the big takeaway from the headline numbers, Q4 and
Thanks, Ira, for having me there. It's always great talking to you, so I thoroughly enjoy our conversation. And coming to the data points today, of course, right spot on with our own forecast for the fourth quarter. We were at a 3.9 for GVA and a 4.1 for GDP. A tad lower, the actual number for the full year at 8.7. We were at 8.8, but almost in line with what we were anticipating. I think most of the factors that we were penciling in terms of the upside and downside have come off quite in line with expectations. And particularly, I would draw the point towards the manufacturing sector, where based on IIP, we were looking at a slowing number in the fourth quarter. But actually, the GVA for manufacturing, which has come at negative 0.2, and probably that reflects the ongoing macroeconomic pressure points currently, namely the impact of the geopolitics, the conflict, the supply bottlenecks, commodity prices. And that is where we see the value add for industry actually is completely begun to now reflect the pressure of input costs. And we fear that this will continue right into the ongoing quarter, the first quarter of this current year. And if we do have these pressure points escalating or not changing for better, we would probably see downside to our growth projections altogether. But coming to the fiscal 22 numbers, I think the clear support did come through the government capex. We did see net export numbers doing better, particularly because our trade numbers were looking good, at least for the fiscal gone by. But all that, I would presume, is more of a rear view mirror kind of a comfort. But going forward, where do we see the headwinds? Clearly, too many of them. But I would stop here and maybe we could take it later as to what we see going forward. But yes, I think the good news of a stable growth has been more or less baked in, but going forward, uncertainties.
Okay, I'll get to the forward part in a minute. Mr. Joshi, what stood out for you from the sectoral numbers? Any surprises in there? Manufacturing, as Shubhada mentioned, certainly was something noteworthy.
Well, I think the agriculture has done quite well. I mean, the Omicron as well as the Ukraine war started in the fourth quarter, and then on top of that, I think the heat wave also hit it started hitting the country in March. So I think I was expecting some impact of that. Probably that will be felt later in the first quarter of this year. So agriculture is still reasonably positive, I would say. The overall, I think the private consumption for the full year continues to trail. I mean, earlier it was 1.8% of it was only 1.8% higher than the pre-pandemic levels. Now it is only 1.5. So I think there is so that catch up has to be done probably in the coming years. Apart from that, I think Shubhada already mentioned about manufacturing. Apart from that, I think a lot of growth rates that we see are driven by base effects. I mean, something contracted in the same quarter last year. I think if you taking that out, I think there's not much of a surprise, I think, in these numbers. I mean, I would say. So this is
how much should we attribute to the Omicron effect? I mean, at least on the consumption number, if you go switch to the expenditure side, there does seem to be an impact, and perhaps when we get around to Q1 of the current year, some of that will, not be there.
Yeah, I think the if you look at the Omicron hits the services the most. So if you look at trade, hotels, and that segment, I think that is now 11.3% below the pre-pandemic level of 2019-20. It was only 10.9 earlier, below that level. So it has hit clearly it has hit the contact-based services more, I think. And then manufacturing is, I think, due to multiple factors, I mean, including, I think, supply chain and many other things, and also weak demand in the system, I mean, getting reflected in manufacturing as well. So,
is that how you see the sort of temporary aspects playing out on Q4 as well, largely on consumption?
Yes, absolutely. I think consumption, both rural and urban, have got impacted because the real disposable incomes have got severely impacted. Food inflation has been the more dominant driver for rural consumption to come on weaker. Yes, there is an argument that the free food grain supply could have alleviated some bit of stress, but not at a broader level in the rural economy. We would feel that the food inflation has begun to impact the discretionary spending in rural economy, and in urban, I think the services inflation that has really shot up would have begun to start impacting the urban consumption pattern as well. So overall, private consumption definitely remains the weakest spot in the overall growth engines, and we fear that it's going to be slow in terms of recovery. Looking at the overall macroeconomic picture in terms of elevated inflation, tighter financial conditions, and so on and so forth, we would see the consumption piece to be a slow mover in terms of on the recovery path.
Mr. Joshi, have we taken out pre-pandemic levels on all the expenditure components?
Sorry, could you come back again?
Have we surpassed pre-pandemic levels on consumption?
Not in contact-based services, I would say. I think the services consumption would still be trailing.
Okay, but the overall PCFE, the personal consumption final expenditure has.
That's right.
Yes.
That's right. So
I think it's more on the commodity goods side, but services seriously is lacking.
That's right.
Okay. This high nominal growth, and either of you can take this question, 19.5%. I'm sure that's a record high. And it sort of lifts all boats in some ways, Mr. Joshi, tax, corporate profits. So that's been useful in some ways.
Well, it is useful, but I think it also has a cost. I mean, so it creates the nominal growth is high because of high inflation. And I think so in nominal terms, the top lines of the companies will look good. The government's tax collections will look good. But I think if you look at the margins of the firms, I think they're going to be weaker this year. I mean, despite the inflation remaining high. So because they're not able to pass on everything.
Yeah.
Just remember that I think what we see in nominal growth, I think is inflation in WPI as well as CPI put together. I mean, it's not so. I think since WPI has been so high, inflation has been so high. So that's, I think, pushing the nominal growth much higher. I think the companies this sort of inflation it creates more dichotomies in the system. I think as the rural economy is facing much higher inflation right now. I think the job opportunities are much lower. I think because the services that are rebounding are mostly in urban areas. So it will eventually hit consumption. So there is a positive side to it, but I think at the same time, I think to control inflation, government has to spend so much more, I think, to protect these vulnerable segments. So I think on a net basis, it's a negative. I mean, I would say.
Yeah. On a net basis, it can be a short-lived comfort in terms of a nominal GDP being very high, because as DK was also saying, we have seen a double-digit inflation in WPI in FY22. And given the kind of a mix of WPI, CPI that would have been taken on board while computing your nominal GDP, it would obviously, we were ourselves looking at a 19%. So 19.5 has been a tad higher. So going forward, somewhere the inflation starts biting, and it's going to start affecting your real GDP numbers also. And that is where, are we going to see a repeat of a 19.5 or that kind of nominal GDP? Most likely not for fiscal 23 is what we believe. because somewhere not just the central bank actions will work towards moving the inflation down, but more importantly, it would be very important to take a cue on the demand conditions in the economy, the aggregate demand conditions.
And that allows me to just pick forward a little bit and talk about what lies ahead, Mr. Joshi. So, the chief economic advisor was asked in a press conference whether India faces the risk of stagflation. Now, it may not be traditional stagflation, but stagflation-like conditions is not something we can rule out entirely, right? If the growth momentum slows, although we have the comfort of government spending, which could perhaps keep things buoyant, relatively buoyant.
Yeah, I think that scenario is there, but I think of where the growth slows down. See, recession in advanced countries might be negative growth. For us, I think even slowdown in growth, you'll feel the pain to the same extent. I mean, so I think even if the growth goes down to 4%, 5%, I think then you'll definitely feel the pain across the board. So so that would be kind of a weak. Almost recession-like. So we have growth recession. I mean, let me put it this way. We don't have the output contracting. Now, I think what happens to GDP, there are too many moving parts right now. I think I'm pretty sure that almost all forecasts are going to need revision going ahead. Our current forecast is 7.3%. Now, I think there are three key headwinds, I mean, to growth. One is global growth is slowing pretty fast. And the kick that you were getting from exports is going to be missing next year because exports react very sharply to global growth, whereas imports are going to remain high because, there is no substitute. I mean, you will need to import at higher prices. So clearly, so that is, exports minus import component is going to be negative for growth. So number two, I think the high crude commodity prices led inflation, it destroys the purchasing power of households. It's pretty well known, and also causes margin squeeze for companies. I mean, so the EBITDA margins are already being predicted to be lower. I think CRISIL is expecting, I think, margins to fall by 150 to 200 basis points in this current fiscal. And then I think more importantly, the fiscal space for pushing capex has got somewhat reduced because you have to spend so much on subsidies. I think so. That has implications for medium term. Either government accepts a higher deficit, or I think they'll have to cut somewhere. Something has to give in. I mean, so I think these are the headwinds. But the supporting factor this year, which I believe will play out, is that the contact-based services, I think they are going to show a very strong rebound, particularly if the COVID remains under control. So that will. So that's still about more than 11% below 2019-20 levels. So you can expect what Milton Friedman used to say, a plucking effect. I mean, you pluck the string of a guitar down, it goes up immediately. So I think that kind of effect we saw in some segments earlier. I think we haven't seen that in services so far. April and May are showing some resilience of services. It might continue going ahead. Second, I think, is that the RBI is raising interest rates. They might front load it, but the peak impact of these interest rate hikes will not be felt immediately. I think that will be felt towards the end of this fiscal year. So I think that's a point to worry about for the next year. So not much impact of high interest rates on the economy. And so I think on a net basis, I think we still expect 7.3% growth with risks tilted downwards. And I think we'll keep looking at it as we get more information.
Sort of questions related. One, I'd say 7.4, or most people are in that vicinity. The sequential sort of growth momentum will slow, right? I mean, matching the annual numbers to the sequential numbers, you will see a slowing, obviously, of sequential momentum.
Well, I think it will slow, but no, it will not slow in uniform basis. I think you might see it slowing faster in the next quarter, which is coming. I think April to June will still be strong because I think we know April and May numbers are strong, and I think July to September is what you need to watch out. I think there it could slow down, and towards the latter half of the year, if oil prices do weaken, I think then you could again see sequential growth picking up. So it's going to be a non-uniform, non-linear kind of a story. And finally, I forgot to mention that monsoons are expected to be normal. So that's a big positive. The problem, I think, is that the weather has become very freak and unpredictable. So whether the monsoons will be uniformly distributed across regions and across time, or whether we will get heat waves or I think floods, I think that we don't know. I mean, so that you have to keep your fingers crossed on that.
Absolutely. Shubhada,
That's
what's
right.
your sort of prognosis for the year ahead? Throw in one sub-question, and that is the condition of states. The reason I asked is that just before the GDP data came, there was some news that the government has, pushed out whatever GST compensation was due to states, and there's only one last tranche left before the compensation ends, although there's some back, the test will continue. I'm just wondering if state finances will become a significant sort of variant in this entire GDP story, given that we are depending on capex, government capex in a big way.
That's for me, Ida?
Yes, sure. Yes, sure.
Yeah. So, yes, I think there's a lot of back and forth going on in terms of the GST compensation ending now and states trying to contest it because it's still in, the lingering impact of the abnormal years of last 2.5 years or so on. But the fact is also that, crude oil ad valorem also gives a big benefit to the state finances, because that gives them a fair bit of a cushion in terms of additional resources of funding. And that is why there could be some set-off in terms of GST compensation not forthcoming from the center. So one extent of support definitely comes from there. The second is, yes, a lot of capex gets pushed through states bearing a larger funding burden. But of late, a lot of infrastructure designs have been such that center is sponsoring a fair bit of project financing, and therefore perhaps going forward we could see, if not dominating, center would be making some role to play. They will have some role to play in a larger infrastructure financing going forward, even if those projects are domiciled in different states. So I would think that capex is one support that we are not taking off in terms of a growth engine. Two factors. One is, of course, our capacity utilization economy-wide have improved dramatically. I think from 69% odd, now currently they stand at 72, 72.5. And the past numbers show us that whenever there is a capacity utilization economy-wide going to 74, 75 levels, it triggers a more broader-based capex-led recovery in the economy. And that is what we would look forward to. Two things. Government, as DK was also saying, the government is yet continuing with its push towards capex. Challenges will be aplenty because of the resource crunch and the pressure on the expenditure side through subsidies and so on. But I would think that early days yet for all of that pronouncement to be brought in right now. Going forward, pretty much ECO and our own forecast is 7.3 with a downside risk. And we do believe, though, that the probability of risk is now getting higher. For the simple reason, if you just do a thumb rule basis estimate of impact of crude oil, even at 110, it would have a 20-30 basis point of direct impact on growth. And if we are to look at an average of 120 for the year, and as of now, we do not see signs of oil cooling off very quickly because of the conflict, all the sanctions that are coming the way. Today, EU announced its sanctions on oil demand from the region, from Russia. All of these are going to have a role in playing for crude oil prices to remain elevated. Question remains, how much do we access Russian oil? But that's altogether on a different turf. The short point is oil is going to dent some of the growth numbers going forward. I would think still that the larger risks would also come from the availability of growth capital. Now, if you see over the last 1 or 2 quarters, the capital being raised by corporates has begun to correct, even as a ratio to GDP. Now, that is something of a worry. There are various reasons. The cost of funding, the debt funding route is going to be not a very cheaper route any longer, domestic or global. Second is because of such a sharp volatile environment in the equity markets, even the IPOs are still waiting in the wings and in the pipeline. So growth capital is something that you may not really find it that easy coming by. The way we saw saw maybe 4 quarters ago. So that is also going to form a little bit of a constraint as far as, funding. Where do you fund your growth from? Yes, bank capital is in double digits, it will grow, but how much of working capital needs and how much of capex we need to still, look at. Monsoon, of course, we are still looking at that, providing some support for rural consumption, perhaps in, going forward in the second half, getting better. We'll have a better outlook of monsoon. The terms of trade have begun to favor the rural farmers. So those two should broadly help the rural consumption story, but I would still feel that that would be more, in visibility towards the H2 of the year than H1. Overall, I think we do see a stacking up of risks, more to the downside of 7.3 outlook that we have. Key factor and risk factor continues to remain energy prices, and that is something that we would be continuously watching out for. I still remain relatively sanguine in terms of not looking at a growth of below 6.5 or those kind of numbers that some of the analysts perhaps are putting out, because we do have some resilience in many of these growth factors that we go forward in terms of a PLIs. Yes, we will have to be reflective of how we harness the trade deals, how we manage the input costs. But if we were to look at next 18 to 20 months, probably the growth levers will start looking in a better shape.
A quick last word to both of you. Mr. Joshi, you mentioned, sort of the front loading of the RBI and the RBI MPC's rate hikes. But fair to say that the growth numbers are not going to sway them right now. They don't have that luxury.
Well, I think as I said, I think they're not going to. They might reduce their growth outlook, but not significantly. I think right now it's too early in the day to, I think, be very affirmative on where it is headed. So, but the key fear right now is on the inflation front, and I think the surprise there will possibly be food. I think food can spoil the party. We know that fuel is already spoiling the party, but if food joins in, then I think it's already joining in. I think that will be, and then second is the services are. Some leg of services are seeing very sharp increases. So I think they will be focused on inflation right now. I think the balance has already tilted towards inflation, and it's going to remain that way.
Yeah, you would agree.
Absolutely. I think there is going to be a front loading of rate hikes in response to their revised upward trajectory on inflation. I would look at more coming at close to 6.3 to 6.5 range, in my opinion, is what RBI would look at from a 5.7 revised number, because the first half is definitely looking well above 6.5. A second half, who knows what's going to happen to crude oil and so on. But with that kind of a degree of revision, upward revision in inflation numbers, not as much on growth, I agree with DK, because they are currently at 7.2. Perhaps they will definitely flag off the risks towards downside, but nothing very concrete and tangible yet for them to put a number to it. That's my opinion. Whereas for inflation, they have very concrete reasons to push it up to by another 60 to 70 basis points for sure. And given that kind of inflation trajectory, I mean, we do see over the next two policies, RBI trying to get close to 5.15. That is the pre-pandemic. We don't want to get onto the number, but basically as quickly as possible. The second half of the monetary policy review is by end September, 29 September. I would think that they would probably have their rate hike visibility for the next 2 to 3 policies, and perhaps take a pause thereafter to assess, because in their own assessment, the growth for the second half is averaging by around 4.5%. Now that would be a little bit incongruous that if they're looking at a growth at 4% and they continue to raise rates, of course, the joker always is the crude oil prices and its first order and second order impact. But given no further acceleration and negative surprises, I would think over the next 2-3 policies, they would like to quickly normalize, including a normalization, trying to get liquidity normalized. So we are still penciling in a 50 basis point hike in a CRR in the June review.
I'll leave it at that. Thank you both so much. Lovely to have you, Shubhada, back. And
Likewise.
Joshi, thank you
Pleasure.
so much for joining us again on BQ Prime as well. And
Always
thank
a pleasure. Always a pleasure, Ira. Thank you.